Hello, everyone. We're going to go ahead and get started in the next couple seconds here. I just want to give it a little bit for people to get settled, but thank you for joining. Okay. All right, I'll go ahead and get us kicked off here. Thank you so much for joining us today to talk about loan repayment strategies with our office, Student Financial Services on the medical campus, and then Ann Yeager from the Association of American Medical Colleges, AAMC. My name is Catherine Wilson, and I'm joined today with some of my colleagues from Student Financial Services. We'll be helping out in the chat and the Q&A section. Before I pass it over to Anne, for those who are graduating, we want to give you a huge congratulations on your upcoming graduation. We look forward to seeing your continued success as you enter this next chapter of your life. And if those of you who are joining are not yet graduating, we look forward to working with you as we kind of get through this next year and information about loans. As a reminder, you will want to make sure that you have completed all of your exit counseling requirements if you are graduating and you're leaving. For those of you who have borrowed federal loans, we have emailed you regarding federal loan exit counseling through studentaid.gov that you will need to make sure you complete. For those of you who have any institutional loans, so Boston University loans, you will have received an email regarding exit counseling instructions through ECSI. So you'll want to go ahead and check that before you graduate as well. This webinar will help answer questions about federal loan repayment strategies and tools as you enter that repayment period, and it'll also give you an overview of any current or as current information that we have on federal regulations and things going on as things have been changing frequently, so you can get the most up-to-date and accurate information. In terms of housekeeping for today, please make sure that you are staying muted as we go through the presentation. If you have any questions, you can feel free to drop those in the Q&A section or the chat section. Any questions that we're not able to answer live, we'll make sure that we have some time at the end of the presentation to address anything that hasn't been already answered. And we'll also be recording this webinar and posting it to our website. So feel free to take any notes while we are going through the presentation today. And if you go back and need to listen to it again, if you've missed anything or if you have other questions, feel free to go ahead and review the recording. But thank you so much for joining us, and I will turn it over to Anne.
Thank you, Catherine. Hi, everyone. Thank you so much for joining this evening. As she mentioned, my name is Ann Yeager, and I'm with the AAMC, the Association for American Medical Colleges. And our team, we work closely with medical schools, generally, and some dental schools and other health profession graduate schools to provide repayment counseling presentations to you all to kind of give you a good start and hopefully some guidance on your next steps and kind of get started. We know, obviously you complete your exit counseling through studentaid.gov, but sometimes there's additional questions, especially if you are a health profession student and, exploring, what your career is going to look like in terms of repayment and options that may be available specifically to you all. So thank you so much for being here. As she mentioned, the Q&A box or the chat for questions, and then I will be providing obviously the recording, as you mentioned, but also copies of the slides I'll be sending out later tonight to Catherine and Stephanie, so that those will be shared, I would think sometime soon as well. So with that being said, I also want to say congratulations to, finishing your degree. Obviously, it's always a good springtime, something to look forward to, graduation, obviously right around the corner probably. And then whatever your journey looks like after that, whether you're going into a residency program or, if you have, job offers already available or you're still, working through that process in terms of securing employment. We're going to talk through loan repayment and what that can look like for you. Generally, the questions, will you be able to repay your loans? How do you select that repayment plan? What is public service loan forgiveness and how do you apply for that? We'll talk a little bit about consolidation and refinancing so we understand what those different terms mean and if that's something you should consider doing. And then, of course, we'll talk about what's currently going on with the student loan program, which is, if you've been paying attention to the news, there's lots happening and hopefully provide some clarity around any issues. If you have specific questions on what's available, we will touch on the current available income-driven repayment plans that a lot of borrowers do end up needing to choose in order to have flexibility in their payments. So we'll go through all of that. We're going to talk about the timeline for repayment, where to find your loan information. Oops, jump ahead there. And then we'll run through a couple different repayment scenarios and then talk about budgeting in your monthly payment, once we have an idea of what that might look like, and then providing additional resources for you to take with you, as you move through this next chapter of your life, in regards to your financials. So for timeline for repayment, kind of what we like to get started with is for graduating students right now. You will want to understand what type of loans you have if you aren't already aware. So do you have all federal loans? Do you have some federal and some private? Do you have those institutional loans from your school? Just understanding where you're at with the types of loans. And then before graduation, just kind of, again, rough timeline of kind of tracking these things, but understanding once you know the type of loans you have, if you have any loans that you may have already used your grace period on. So this could be if you had loans from undergrad and then you took a break before you started graduate school that was longer than 6 months. Those loans, in that case, would have used your grace period on your undergrad loans, which means when you graduate, then those loans would be due or enter repayment immediately, within a month or two after graduation. Whereas any loans that you had borrowed while you were in school during your graduate program generally will have a grace period and you won't be required to make payments for at least 6 months. So if you have loans with two different timelines, it's just important to understand and be aware that your process may start sooner if you've already used your grace period. I will clarify that you do have to use the full grace period to lose it. So if you, graduated with your undergrad with loans and then you entered your grace period and you were in that grace period for 3 months and then you started a graduate program, you did not use your grace period fully. So you still have that full 6 months after graduate school to repay those loans. So it has to be that you exceeded that 6-month mark already for your loans to have already entered repayment, which is a good thing. Next, then, upon graduation, just understanding or, what consolidation means and if that's something that you should do or shouldn't do. There's really no right or wrong answer to that usually, but we'll talk through that process and you can decide if that's something you want to look into. And then if you are beginning a job and you're working, right out of school right away, and that that position is going to qualify for public service loan forgiveness, then you can start that process of submitting your PSLF form. We'll talk through that and what that looks like, once you have secured employment that does qualify. Again, maybe not the case for everybody, but we'll touch on it and make sure that for those of you that are pursuing PSLF, you know what your next steps will be. And then 90 days before your grace period ends, and I will talk more about the grace period again here in a minute, but 90 days before that ends, you will be required to select a repayment plan. So we'll talk through what some of those options look like. And then just know that, if you're graduating in May, your grace period likely is going to end in November. So you'll be able to make that selection sometime in the fall. So September, October timeframe. And then if you do choose an income-driven repayment plan, meaning that you're choosing an option that you're basing on your income, you do have to recertify that every year, your income that is, every 12 months. Those plans are good for in order to stay on the plan. So you will be required to take action at some point, towards the end of that 12 months. Again, 90 days before that ends, you'll be requested by your loan servicer to provide additional information on your updated income. So that's basically the timeline between now and the end of your first year of repayment. We'll talk a little bit more about just so we all are on the same page about some of the terminology I'm using. The grace period again is generally a 6-month time frame where you are not required to make payments. It's given that time to you to help you, transition and start working and start, may not have a paycheck right away, but kind of transitioning to when that first loan payment would be due. Most federal loans will have a 6-month grace period. So that includes the subsidized loan if you had received that as an undergrad, unsubsidized for both undergrad and graduate level, plus loans, again, for graduate level with the grad plus loan, all have a period of 6 months. The difference with the plus loan is that it's not called a grace period. It's actually called a post-enrollment deferment period. And I'll highlight in a few minutes why it's just important to understand the difference there. But generally 6 months. If you have Perkins loans, which are a older federal loan, they aren't offered anymore, but some of you may have received a Perkins loan when you were an undergrad. If you have a Perkins loan, it will show up on studentaid.gov, and just know that you have slightly longer in terms of a grace period on that loan. And again, just to kind of go through the terminology, subsidized loans just means that when you borrowed that loan and it would have been undergrad only, the government was paying interest for you on that loan while you were in school. So no interest should have accrued on a subsidized loan. Same for while you're in your grace period, during any deferment periods, and then certain periods in some of the income-driven plans, you can remain eligible for that subsidy for a short time. Some examples of those loans include, again, that direct subsidized loan. The Perkins loan is considered subsidized, and then the LDS and PCL. I know the PCL is specific to medical students, but the LDS I think is available for other health professions as well. Those are not through FAFSA. Those were through a different um, federal branch of government that offered those loans. So they are slightly different in terms they won't show up on studentaid.gov, but they are considered subsidized, meaning they did not accrue interest. So if you are a student that has one of those type of loans, just know that you have not accrued interest on those yet. And then the unsubsidized loans, which we're all probably a little bit more familiar with, are, at least at the graduate level, the borrower is responsible for the interest from the date that you borrowed that money. So interest has been accruing the entire time. It will continue to accrue while you're in repayment, while you're in your grace period, basically until the loan is paid in full. So this includes those unsubsidized loans, undergrad and grad, your grad plus loan, and then if you borrowed any private loans, also applies to that as well. Generally, private loans will start accruing interest, the moment that money is given to you. We will focus on the unsubsidized and grad plus loans for the majority of this presentation, just because that's what most graduate students end up borrowing in terms of what your repayment options are going to look like. I do want to touch on interest capitalization, what that means. So when there's a couple times interest can capitalize, and that just means that any accrued interest you have on a loan that hasn't yet been paid off gets added to your principal balance of that loan, and then the interest starts accruing on that new higher balance. So it costs more money when interest capitalizes. This can happen in a couple instances. One, it happens after a deferment period ends. So specifically on that grad plus loan, as I mentioned, doesn't have a grace period, it has a deferment period. So when you leave that deferment period after 6 months and enter repayment for the first time, if you have a grad plus loan, you're going to see that balance increase in terms of your principal balance because your interest is capitalizing at that point. Another time that it can happen or does happen is if you are on the income-based repayment plan, which we're going to talk about here in a few minutes, and you decide to leave that plan, if you don't recertify your income each year like you're supposed to, or you no longer qualify to be on that plan because your income got too high, then any outstanding interest that you have that hasn't been paid on your loans will capitalize at that point. That is specific to that IBR plan. So just wanted to highlight that. So where to find your loan information? If you have all federal loans and you have all federal loans, studentaid.gov is going to be your best friend from here on out. It's where you filed your FAFSA, but now it's going to be where you manage your student loans and start the process, do your exit counseling, all of that good stuff. If you have those institutional loans that Catherine had mentioned, those were awarded to you by your school, they're serviced by your school or their third-party servicer, which I believe that they do work with another company. So you want to make sure you're following that exit counseling, understanding the terms and conditions of that loan, and not losing sight of these loans because they are separate from your federal loans. You will be required to make a payment on them. So understanding the timeline and where you're going to make those payments is important. And then finally, if you have private loans, so maybe you borrowed a private loan as an undergraduate student, or maybe you borrowed one as a graduate student, that would have been, you would have applied for it through a bank, maybe a credit union, and offered, separate from the federal loan. So it's completely different process and organization that owns those loans. So if you are not aware of who you might owe that money to, or you kind of need a refresher, you can find all of that on your credit report at annualcreditreport.com. I also am an advocate to checking your credit report periodically, and right now would be a great time to do so as you're making this transition and you're organizing your finances. You want to make sure that anything on your credit report is accurate and is actually yours, and you understand, what debts you do owe, what's in your name. If you see anything that's on there that shouldn't be, you can dispute it with the credit bureaus. But you want to make sure that information is accurate throughout your life, not just now, but now is a great time to kind of check into that. And then, of course, if you don't know who your private lender is, if you have one, their information will be listed on your credit report. Okay, so back to the federal student loans. This is the current list of federal student loan servicing companies. So these are companies that are contracted with the Department of Education to service or provide the customer service side of loans. So who you're making your payment to, if you have to call and ask a question about your payment plan, these are the companies that can help you. So right now, you've already all been assigned a loan servicer. That happens shortly after you borrow a federal loan. So when you log into your studentaid.gov account, if you don't know who your servicer is already, it should be right on right-hand side, I believe, will have the name of the servicer, the link to their website, their contact information. So that's a good place to start. So if you receive emails or regular mail from one of these companies, you want to make sure you're opening it and reading it because likely they are communicating with you regarding your loan repayment. Just to highlight a couple things about studentaid.gov. So once you log in and you're able to view your account, it's going to show you, again, that servicer information, but you'll be able to click on the details of each individual loan that you've borrowed. And it's going to show you all the different interest rates of each individual loan that you have. I have up here, this is the last 4 years worth of interest rates for graduate unsubsidized and graduate plus loans. So if you have undergrad loans, these are not the rates for undergrad loans. These are all the graduate level loans for the last 4 years. So depending on how long your program was and how long you've been, in your graduate program, you should be seeing interest rates that resemble these listed here. These interest rates do change every July 1st. So depending on when you borrowed that money is depending, which year you were in school, but depending on that calendar year, July 1st is when these changed every year. So just know that, depending on what semester you were or term you were in and when that started could depend on what interest rate you got. These are fixed for the life of the loan. So once you are borrowing a loan for a specific year, that interest rate's not going to change in terms of that specific loan you've already borrowed. It just changes for new loans each and every year. So this, again, just this information is all in your studentaid.gov account. The plus loans, if you have graduate plus loans, the interest rate's always higher. It's 1% higher from the unsub loans. So just important to note that out, because if you have, whether you have unsub or plus loans for this past year, those are the highest rates we've seen in a while. So you're likely seeing 8 or 9% on your federal loans for this last year. Oops. Again, just to as you're preparing for repayment, updating your contact information is key, and you want to make sure that you do that in 2 places, probably 3. One with your school, make sure they have they're up to date your contact information, but also studentaid.gov and your loan servicing company, because although they are kind of working to merge a lot of the, Ed Financial, for example, is one of the servicers that works really closely with the Department of Ed and kind of has integrated some of their processes with studentaid.gov, and that they're all not sharing information that closely just yet. So studentaid.gov will have obviously your email, your mailing address, and then your loan servicing company. You can create a separate account with them to log in to make payments. You want to make sure they have the same email and up-to-date address, because if you're on a payment plan and there's things going on, with that specific plan, they will reach out to you in, both the Department of Ed and the loan servicers. You want to make sure that you are getting that information. Understanding the timeline for repayment, we kind of talked about that already. We're going to look at some income-driven repayment options and some calculators you can use to help determine what that amount might look like. And then another thing I wanted just to point out is if you set up auto pay with your loan servicing company, and this is, I believe, true for most private companies as well, but all of the federal ones for sure, they will provide you with a 0.25% interest deduction in your interest rate if you set up that auto pay. So it's a good idea, just so 1, you're not missing payments, and 2, you can take advantage of that slight interest deduction if you set up auto pay. So when you're entering a repayment, a couple things to keep in mind. 1, you will have a minimum monthly payment that's due, that's calculated based on the payment plan that you choose. Interest is still accruing on your loans when you're in repayment, so just know that each month you're making payments, but you're also accruing interest. You do have to choose your repayment plan before the end of your grace period. If you choose that income-driven plan, again, you'll have to recertify that your income every 12 months to stay on that plan, and then your payments are made directly to whichever loan servicing company that you're working with. I don't see any questions just yet, so I'm going to keep going, but feel free to put questions in the chat as we move through this. Consolidating versus refinancing. So I always want to take a minute to kind of talk about the differences here so we understand the terms, because sometimes they can be used interchangeably, but they don't necessarily mean the same thing, especially when we're talking about federal loans. So for consolidation, there's a loan type called a direct consolidation loan, and it's offered through the federal system, where you can take all of those individual loans that you borrowed throughout your educational career, undergrad and grad, and consolidate them into one direct consolidation loan. You do this right through studentaid.gov. You can select which loans you want to pick. If you have a Perkins loan, as I mentioned before, you can consolidate that into a direct loan. They'll take all of those interest rates that I showed you earlier and give you a weighted average interest rate on your new consolidation loan. So if you're interested in knowing what that might look like, if you want to see what interest rate would be overall, you can start the process on studentaid.gov, click on consolidation application, and on that very first page is going to tell you before you go any further what your new interest rate would be if you were to consolidate. That's the best way to figure out what that's going to be instead of trying to hand calculate it yourself. So there's a couple of reasons why people may want to consolidate. One is if you have multiple loan servicers within the federal system and you want to combine them into one. Sometimes you'll have one servicer as an undergraduate with your undergraduate loans and another one with your grad. It shouldn't happen that way. You should have all one loan servicer, but we have seen where there's been situations where people have had multiple. So consolidation would allow you to choose your loan servicer and then bring everything in with one company. Another reason why people consolidate would be to get access to these income-driven plans or public service loan forgiveness. One example of that would be that Perkins loan I've talked about. If you have that, it's not a direct loan, so it does not qualify for PSLF, and it may not qualify for the income-driven plan either. So by consolidating that, you can include that amount into a direct loan and it becomes eligible. This also was common, not so much now, but if you're an older student that has gone to, maybe is coming back to school, if you have loans prior to 2012 and they were not direct loans, it was a different loan program back then, you could consolidate those older federal loans into a direct loan to become eligible for these options. A more common reason why people do decide to consolidate would be to enroll into an income-driven plan before their grace period ends. So if you, for whatever reason, want to start repayment officially on an income-driven plan and you don't want to wait till December to make that first payment, consolidation moves that timeline up because consolidation loans do not have a grace period. So once you consolidate, you enter repayment immediately. Some people do this for PSLF purposes because they want to start making qualifying payments on PSLF sooner than waiting for the grace period to end. So that's generally why. Again, there's no right or wrong reason as to if you should consolidate or if you should not. You do not have to consolidate to qualify for an IDR plan, and you do not have to consolidate to qualify for PSLF. It's just an option to kind of shift the timeline a little bit. So wanted to get that out there and happy to answer any questions about that if you have any. Okay, moving on, refinancing. So different than consolidating. Refinancing, sometimes this term can kind of be interchanged with consolidating, but they do not mean the same things in terms of what we're talking about. Refinancing would be borrowing money from a private bank and then using that new loan to pay off your federal loans. So basically you could refinance by borrowing from a private bank to pay off the federal loan, and you have a brand new loan in a private bank that's no longer in the federal system. So to do that, generally you have to have good credit, meaning you have a credit history, you have a decent credit score, and you have income. You can show that you have income to be able to make payments on those loans or that new loan. With the federal consolidation, you don't have to have a credit history and you don't have to have an income even to consolidate, but refinancing is basically borrowing a brand new loan. Some reasons why you may consider that is generally interest rates. If you're able to, get a much better rate on a private loan, you could potentially pay it off faster. But what you're giving up on the flip side is all of those federal protections when it comes to the federal loans. So a couple things to ask yourself would be, what does the interest rate look like on my private loan offer? Is it variable or is it fixed? So if it's a fixed rate loan, then your interest rate is going to be this set amount for whatever long term, 10 years, 15 years, whatever the term is. If it's a variable rate, that's where you need to be a little bit careful because they can offer you a really good introductory variable rate that might be very low, but if it's variable, it can change multiple times throughout, the life of the loan, and it can be a little unpredictable sometimes. So you may start off with a really great rate, but then over time it ends up going up, and then you're actually paying a higher interest rate than you were when you had started, or if you had left your loans at the original rate. If you're interested in income-driven repayment or public service loan forgiveness, you do not want to refinance your loans with a private bank because you lose the ability to do either of those options if they're no longer federal loans, and you cannot put them back into a federal loan, into the federal loan system. You'd have to keep it with the private loan from there on. If you're doing a residency program, I know there's some dental students here, so if you're doing a dental residency, or if you're a medical student doing a residency, or if you have another program that does a residency, or even if you don't, maybe you take a job starting off that's not making, as much money as you had hoped, or you think you're going to make in a couple years. The income-driven repayment plans are going to be key for you to help manage that loan debt while you're still in training or while your income is lower. A lot of private loans do not have that option, and so they're just going to expect you to make whatever payment they determine is to pay that loan off in that set amount of time. So just a little bit riskier when it comes to that. At some point, if you get to a point where your income is much higher and you're more secure in your finances and you're paying high interest on a federal loan and you want to refinance, generally it's like, a couple of years down the road before you can safely say, that's a good time to look at this option and make that decision. But everybody's different. Everybody's financials are different. So you just want to kind of do what's best for you. Other federal loan benefits just to keep in mind is that federal loans do have a death and disability discharge provision written into those. So if you become disabled and you are no longer able to work, you could have your loans discharged through the disability provision, meaning you're not, that loan's forgiven, basically, proven that you have a disability that impacts your ability to work. And then, of course, if you were to pass away, worst case scenario, something like that were to happen, that loan would be discharged and it's no longer anybody else's responsibility. Your family doesn't have to take care of that. Private loans, not always the case. If you have an estate, they may have to settle that debt if you were to pass away with a private loan, and that does not happen with the federal loan. So just a couple of things to think about when it comes to refinancing. And then we're gonna quickly, I see we have a question in here, but I'm gonna keep going real quick through the couple of these and we'll circle back to that. So public service loan forgiveness. I know I've mentioned this a couple times already, but just to understand what the program is and what's available is there's a couple of requirements you have to meet in order to be eligible for PSLF. One is you have to have those direct loans. So generally, if you've borrowed loans, within the last 10 years or so, 12 years, generally your loans are going to be qualifying because as long as they have the word direct in the title, that's a direct loan that qualifies. Then you have to be enrolled in an income-driven repayment plan, which we're going to talk about here in a few minutes. You have to be employed full-time by a qualifying employer. So that generally is a governmental organization, a nonprofit, any nonprofit that has a 501c3 tax status is the big one. So any organization that provides public service basically would qualify. And then you're making payments on those loans in a qualifying plan and working full-time for 10 years or 120 payments, 120 months. So if you meet all 4 of those requirements over that time frame, you could potentially have your remaining balance of your loans forgiven after that time. So there's information on studentaid.gov, studentaid.gov/PSLF. There's a PSLF help tool that'll help walk you through how to fill out the forms. There's an employer search. So if you get hired and you want to check to see if they're eligible, you can search by their employer identification number. And then there's an FAQ page as well that has a ton of information about that program. So definitely check that out if you are interested. Some other programs I wanted to highlight, there are other what we call repayment assistance programs available at the national level. The National Health Service Corp is a big one. The National Institute of Health also has a program. And then, of course, different branches of the military offer repayment programs where they will offer you a lump sum that they provide for you to pay off, pay towards your loans in turn for a commitment, a service commitment of so many years. So if you're interested in that service type employment and willing to provide, maybe work somewhere for a couple of years that, is identified as a community in need or, specific locations where they have these opportunities, definitely take a look and see what's out there, see what's available, see what the requirements are. We have on our website, which is linked here at the bottom, a database that has not only the national programs, but also different programs at the state level. So if you are headed to a specific state or you want to check the state that you currently live in to see if they have any type of loan repayment programs, that's a great database to kind of start that search. There's also, it's not just repayment programs, there's forgiveness programs and also scholarship programs. So for most graduates, you want to check the loan repayment assistance or the forgiveness and not the scholarship programs, because a lot of these organizations offer help while you're in school too as well. But I want to just let you know that there also are opportunities after you graduate to get involved and to get some assistance on managing your loan debt. Okay, the repayment plans. Okay, so just a brief background of kind of what happened and where we're at currently. For those of you who may or may not be aware, there was a plan called Saving on a Valuable Education, that was replaced a previous plan called Repay back in August of 2023. Once it went into effect, there was two major benefits of that plan. One was it provided the lowest monthly payment of any of the income-driven plans, and also provided an interest subsidy for any month that you made a payment and it wasn't enough to cover your interest for that month. They were waiving all of the interest for that month, or subsidizing or paying the interest for you. So huge savings when it came to interest, and then also providing that lower monthly payment. This came with some challenges legally. So there were a couple lawsuits filed last summer against the implementation of the SAVE program. So even though we had lots of borrowers who were entering into the SAVE plan, applying for it, it was available, it all kind of came to a halt last summer. Everything's been on hold. So anybody that was in SAVE was put into a forbearance. They were not required to make payments. However, those months also were not counting towards public service loan forgiveness. So everybody's kind of in this, holding pattern of what's going to happen. Fast forward to, throughout the second half of last year and then the first half of this, or the first couple months of this year, there's been additional information. So initially, in December, there was some movement where they brought back two other plans that weren't currently available. So the pay as you earn and the ICR plan. Those went away last July of 24. And then because of the court activity, they brought those back because they were like, we need to give borrowers other options. And then that was in December. And then in February, they took the entire income-driven repayment plan application off the website and said, we have to make more changes in order to follow the court orders here. So just recently, as of March 26th, the income-driven repayment application came back online. The first thing I think we all noticed is that SAVE is no longer an option on this application. Pay as you earn, IBR, and ICR are the three options you can choose from. So while there hasn't been an official court ruling on the SAVE plan, the fact that they took the application down, they made some adjustments to it and put it back up, SAVE is no longer listed as an option, so you cannot apply for it. The other three we're going to talk through and what those look like potentially for you. But just to clear up any confusion, SAVE appears to be completely off the table. But you have other options to choose from. So that's what we're going to focus on. Good news is the applications are back up and live. The consolidation application was also taken down for a minute. That's also available as well. So that's good news for graduates for right now, so they can move forward and select a repayment plan, and knowing that these are the options that you can choose from if you're looking to lower your payment based on your income. If you're interested in kind of seeing the most up-to-date information about the SAVE court case and anything else that may be impacting the repayment plans, this is the best site. It's studentaid.gov. And the announcements page about the IDR court actions, in terms of kind of tracking what's current. There's a lot of information out here, in the media about different, changes and things like that. So if you ever have any questions, they have a, pretty helpful Q&A or FAQ, where if you have specific questions about specific IDR plans, this is where I would recommend you start in terms of getting, valid information. Okay, so that leads me to the repayment scenario. So we're going to go through a couple examples here. Before we do that, just wanted to kind of identify that there's two different options when it comes to repayment with the federal loans. You have your traditional plans, which are not based on your income. So this is just based on the time frame it's going to take you to pay back the loan. The standard plan is a 10-year plan. It is the default plan. So if you choose nothing, if you do not take any action on your plans, they're going to bill you that first month, and it's going to be based on an amount depending on how much loan debt you have and what it's going to take you to pay that off over 10 years. They do offer an extended plan, which can be basically stretching out your payments over 25 years, and then a graduated plan, which is where you start off with a slightly lower payment. It's also a 10-year plan, like lower than your standard payment, but then every 2 years your payment's going to increase. And that's still considered, it's still a 10-year plan, but it gives you a little bit more flexibility in the beginning where your payments are lower, assuming your income will increase, as your payments have to increase. So those are a couple options. And then we have the income-driven plans. So again, the income-based repayment, pay-as-you-earn, and income contingent. Income-based and pay-as-you-earn are both based on 10% of your discretionary income, and the ICR income contingent repayment is based on 20%. So it's a higher payment that you pay on the ICR plan. We're going to focus on IBR because for most graduate students, IBR or pay-as-you-earn are probably more beneficial to you than the ICR. They just have other benefits built into them. The income contingent plan, if you have a parent that borrowed a parent plus loan for you as an undergrad, they only have one option, and it's that ICR, that income contingent plan. So it's on here as an option, but we're not going to focus too much on it just because there's better plans available. This
And
chart
we have
again,
a quick
yeah,
question. I
yes,
just was hoping
yes,
you can go over.
absolutely.
Would you be able to kind of go over the difference between forbearance and deferment, specifically for those who are interested in doing either while they're in their residency? Which one is better,
Yes,
if any?
absolutely. So if you are going into a residency program or a fellowship for that matter, both terms kind of count here. If you're in that training period where you're working and you're earning an income, but you're still considered in training, meaning you're in that residency program, you have the option to choose to go into forbearance versus starting repayment. And all that means is that you request it through your loan servicer, they'll approve it for up to 12 months at a time, and then you could every year you want to do that, as long as you're still in that training period, you can request that. It means no monthly payments will be due. Interest is still going to accrue on your loans during that time. But basically, you're just, not making payments until later on when you're no longer in training. In terms of if it's the best option, it's really going to depend on your goals and what you want to do financially. If you need so sometimes if you have, let's say if you have private loans also in addition to your federal loans, and the private loans don't offer much flexibility when you're in residency, you have to make those payments. There's no way around that. So I have seen, borrowers who took the forbearance option because they needed to be able to focus there and provide, spend that money, their income, on managing their private loans before they had to manage their federal. So it gives you flexibility in that regard. If you have other financial obligations and you just really need, if your income's, low and you don't want to, have to make payments on your federal loans, that would be one thing to consider. In terms of what it looks like when paying off your loans, like obviously if you're wanting to be super aggressive and pay on your loans and being in a payment plan, not making payments during a forbearance period is not going to get you there any quicker. But some people also like the flexibility of being able to put their loans in forbearance and then make payments as they want to. That's another, thing to consider. You are absolutely able to make payments, no matter what loan your status. You can make payments right now if you had the funds to do so. In your grace period, if you're in forbearance, you're always able to make a payment on those loans. So you would not have any, required monthly payment. The Just another question that just came in. Does the interest still capitalize? So it would capitalize at the end of a deferment period. So if you're entering forbearance, it's not considered deferment. So it wouldn't necessarily capitalize. If you were to, I guess it depends on when you entered the forbearance. So if you used your grad plus deferment period and then you entered forbearance after that, your grad plus is probably still going to capitalize, but your unsub would not. And then when you leave forbearance, my understanding, it's not considered a deferment, so it would not capitalize. It's just if you had put it yourself into a deferment, like there's other deferments that you can use, like a hardship deferment, or economic, if you have, let's say you lose your job and you can't make payments because you don't have the funding to do so, depending if it's a forbearance or deferment, after deferment, interest would capitalize. The other thing to consider, just depending on how you want to manage your loan debt, some people will go into forbearance for a couple years while they're in residency and then enter a standard repayment plan of 10 years and then pay it off that way. Depending on your loan debt and what that looks like, it's I think more of a behavioral probably question, economics question at that point. Like, am I okay with not making a payment for several years, knowing the interest is accruing, and then entering a payment plan to pay it off in 10 years after that? So I can't say which is best because it's really going to depend on your financial situation. But thank you for asking that question. Let's see if can we switch the plan we initially choose the following year? For example, if I choose extended, can I switch later? Yes, you're always able to switch payment plans. If you're on extended, let's say you start on extended and you decide you would want to go to an income-driven plan, you would just fill out the income-driven repayment plan application. Any of the traditional plans that we have here, these are not based, the ones in blue are not, you don't have to, once you're on them, you don't have to take any action to stay on it. You're going to continually stay on it unless you decide to switch to an income-driven plan. So graduated, they're just going to assume your payments are going to go up and they'll let you know what that is. Extended is just extending it out over 25 years. excuse me. If you so if you're on extended and then you want to switch to IBR, for example, you just fill out the form. At any point, you can do that. It doesn't have to be after a full year. So if you choose a 25-year income-driven repayment plan and then decide to pursue PSLF, will my loan be forgiven after 10 years? So if you're on an income-driven plan, and let me see if I understand this question. If you choose a 25-year income-driven plan and later decide to pursue public service loan forgiveness, will my loan be forgiven after 10 years? So you have to be working, you have to be on the repayment plan and working for a qualifying organization at the same time, basically. But that doesn't mean, like, if you, let's say you chose to be on an income-driven plan and you make payments while you're working somewhere that qualifies, but you never fill out the paperwork, but then later on you say, I'm going to fill the paperwork, as long as those dates of your employment match up with dates that you made payments on the loan on in a qualifying repayment plan, they'll go back and count those months as long as, you know, it was during the same time frame. It's recommended that you fill out the paperwork, you know, once you start a position, and then every year, you know, once a year, just to keep your payment counts current. But you can go back and have employment count as long as you've met all the other requirements, meaning, you know, you just didn't fill out the form, but now you're looking back and you're like, okay, well, I did work somewhere. I was on a payment plan. I want those months to count. Even if you no longer work there, as long as you can have that verified and fill out the form, you could still get credit for it. I think is hopefully what you're asking. I think I was on this one. So this slide, again, more for your information once you have access to these slides, just to kind of compare the differences between the different repayment plan programs. Again, save is on here. Recent change, you know, we know that's no longer, you know, an option. But between the other three, the differences between IBR and pay, there's slight differences, but when it comes to the payment amount, it's going to be calculated the exact same way. So it's 10% of your discretionary income, which is your adjusted gross income minus 150% of the poverty guidelines to determine what that monthly payment amount is. Both plans will cap your monthly payment at whatever your standard monthly payment would be. So no matter how much money you make, your payment will have a cap and you won't be required to make payments over that amount that was initially determined to be your standard amount. The other thing to note on both of these plans is you do have to qualify for them, meaning you have to have a partial financial hardship. And all that means is that when you enter one of these plans, whatever the calculation is, whatever they determine your payment to be based on your income, your payment calculation cannot be higher than what your standard payment would have been. If it's higher than what your standard payment would have been, then your income is too high to be eligible for one of these plans. So generally starting out, most graduates are eligible for, you know, one of these plans. If one, it's going to depend on your loan debt, but two, your income. So if you have a lower income or no income, you know, first starting out, generally you can get into the plan with no problem. And then again, I touched on this earlier, but if you're on IBR and then you switch to a different plan, your interest does capitalize on both your unsub and your Grad Plus loan. So anything you hadn't, you know, been able to pay off in terms of interest would capitalize if you're on IBR and then you decide to switch to something different. Another important thing to note is that if you are on any of the income-driven plans, if you're married and you file your taxes jointly with your spouse, they will consider both incomes when determining your monthly payment amount. So that's important to note because for married couples, it does change. Sometimes, you know, you have to think through a little bit of how you want to file your taxes, what kind of implications that has. If you file married filing single, or married filing separately, and you both have your own tax return, then these plans currently won't consider the spouse's income, but sometimes there's tax benefits of filing jointly. So you have to kind of weigh the savings you're getting tax wise versus how much it's going to save you on your student loan payment. So a little bit more of a, you know, research you have to do in terms of what the best decision will be for you as a couple, if that's the case. I have a couple examples here just to kind of show you what loan repayment might look like based on two different scenarios. So we have federal student loan debt about $65,000 and your expected yearly salary of $70,000. So again, you're going to have a couple options, either the traditional repayment plans that are not based on your income or an income-driven payment plan. I use the student loans simulator to determine, you know, what these payment amounts look like. So just, you know, right off the bat, this first one, the standard repayment plan on $65,000, your monthly payment is going to be $739 a month for 10 years, and then it's paid off. So if that $739 is not something you feel that you can afford, then that's when you would look at an income-driven plan, or potentially, in this case, lowering it by picking a different option. That graduated plan I mentioned, again, is a 10-year plan, the one in the middle here, where your payments are going to start off smaller. So it would, bring your monthly payment down to 425, but every 2 years that's going to increase. And by the end of the last 2 years, you're going to be paying $1,200 because you're still trying to pay that off within 10 years, but they're giving you, the ability to lower that payment in the beginning of that payment plan. And then the extended payment plan, this would be paying it off over 25 years. Again, this is based on $65,000 in student loan debt. So totally recommend, if going into studentaid.gov, using a loan simulator, it'll obviously pull your own actual loan debt balances to determine what your payments may be. But it's important to look at these options. And when you go through exit counseling, I probably will show you some of these as well, of what your payment amount could be based on, these options. The other thing I wanted to note is the income-driven plans. So right now, this loan simulator is not the greatest tool to use, only because it's not completely up to date. So you're going to see some warning messages and things that the SAVE plan is still listed there, and it's going to tell you that these plans may not be accurate. It's not accurate because of everything that was happening with the court case with SAVE. We know SAVE's not an option, so I would ignore, when it tells you that SAVE's a recommended plan because it gives you the lowest monthly payment, I would ignore that and look at your other options as well. The loan simulator also won't show you what pay-as-you-earn and ICR payments are right now, but it will calculate the IBR plan. And just know that the IBR and the pay plan are going to be the exact same when it comes to the payment amount starting out. When you actually apply for these plans, you will have the option to choose IBR, pay, or ICR. It's just that calculator has not been, they haven't, put in all the updates to it yet. And because pay and ICR were set to go away, but then they came back, they haven't added them back in. But that's why we're going to focus on IBR, just to show you what that monthly payment looks like. So if we go back again, so your standard repayment plan, $739 a month. And then you have your other two options here that are traditional. And then the income-based payment was going to give you the lower monthly payment at $395 a month. Obviously, if you're depending on what your concerns are, if you're trying to get the lowest monthly payment, IBR is going to be your best option. If you're trying to limit how much you're paying overall over the long term, then standard is always going to be the amount the least amount that you pay over time, because it's 10 years and it's the quickest way in terms of your how much you're paying in interest over time. But knowing that it's not always feasible to make a payment that high, when you're first starting out. So that's, using that simulator just to kind of get an idea of what your situation looks like. I also have another example here, same loan debt, 65,000 with a higher salary of 100,000. Again, net standard payments, 739. Your graduated looks the same, extended is all the same, but then in this case, the IBR payment, because your salary is higher, is $645 a month. You still qualify for IBR because that payment's $645 and it's still lower than that $739. So if your income goes too high, depending on your loan debt, whatever the standard amount would be, then you may not qualify for IBR. So that may be the case for some of you, depending on how much you have in loans and what you potentially might end up making. But I just wanted to give a couple examples here to kind of show you what that looks like in terms of options. Couple other things to note. The income-driven plans are based on last year's tax information if you have it on file. So the IDR application itself asks you, did you file taxes in the last 2 years? So if you can say yes to that, then it's going to base your first year's worth of payments based on whatever tax information you have in file. So just keep that in mind, because some people, you may have worked a little bit and or maybe you filed even though you didn't have an income, that would give you a lower monthly payment for that entire first year. And then next year, when you file your taxes again, it's going to be based on whatever you made in 2025. And then every year you're going to recertify. So it's going to progressively go up in theory. If you didn't file taxes, or if you don't have a tax return on file, then the question asks you, because if you say no, I didn't file, then it'll say, do you currently have wages? So at the time you're going to apply for these plans, if you are not working and you don't have wages, you can say, no, I don't. And then they'll calculate likely a 0 monthly payment because you don't have any income. But if you've been working, then you say, yes, I have taxable wages, even though I hadn't filed taxes yet. And then they'll ask you for additional documentation, likely your paycheck stubs, and then they'll base your payment based on, your current income. And then each year after that is 1 year later, you'll have to recertify. So it'll be based on your prior year's taxes. And then I mentioned the married filing taxes with your spouse. So if you are married and you file jointly, your spouse's income will be factored in to determine that payment amount. So just kind of to wrap up here a little bit, and we can go back to see if there's additional questions. Using the loan simulator is going to be the best way to get yourself an idea of what your payment amount might look like on IBR or one of the standard plans or traditional plans. Once you have that, I think it's just important that you try to work that in. Think about your budget. Start, if you're starting a new job or you're transitioning to the next, portion of training, how are your expenses going to change? Do you want to start making that payment? If you have the option to maybe put it in forbearance, kind of work through your budget, whatever you can do. And I know we've all found our own ways to manage our money at this point in our lives, but as you're kind of going through this transition, it's a good time to kind of go back through your expenses if things are changing, if you're moving, and identifying what you have going out versus what you have coming in, and anything you can do that will get you, going back to that same tool every month. So whether that's using a spreadsheet or using an app, just writing it out, anything that you're going to be consistent with is important. So there's, in my opinion, no right or wrong way to budget, but whatever you're going to stick with is key to keep you on track. And then also know that whatever decision you make right now likely you'll have to reevaluate at some point. So, as your income changes, as your life circumstances change, your marital status, your household size, your financial goals, like maybe you pay off a debt and now you want to focus on something else. Like all this is going to be evolving. So you do have to every so often just take a look and say, okay, this is the plan I chose. This still makes sense. Do I want to stay on this path or do I need to be more aggressive or do I need to find another way to pay this off? The question that just came in, and Catherine, I know you're answering it, but I just want to say this one out loud too, is can you still qualify for PSLF with a 0 monthly payment for the first year? Yes. So if you are on an income-driven plan and the calculated payment is $0 a month, those $0 payments count as qualifying payments towards PSLF. If you're in your grace period or if you're in forbearance and not making a payment, or you voluntarily make a payment, those are not going to count. But a calculated 0 monthly payment on an official IDR repayment plan, because it was calculated as a payment amount, even though it's 0, would count towards PSLF. So that's a great question. Thank you for asking that. And then some additional resources for you all. We have a lot of our resources are geared specifically toward medical students, but when it comes to the financial aid and the student loans, is very relevant for all graduates to take a look at some of this information. So we have a lot of resources on our webpage. As I mentioned before, we have that repayment assistance database that you can find is linked right on our page. We have webinars and videos and a lot of just financial topics in general. All are recorded. If you're interested in learning more about that, we do have, again, it says graduating medical school checklist, but this checklist really is relevant to any program. It kind of walks you through a lot of what we talked about today, just to kind of give you kind of a guideline of what you should be thinking about and looking at. I did want to just highlight that we have, through our medical students, and I just had a presentation with them earlier today, so I did not focus so much on the medical students necessarily in this presentation, but we have a calculator specific for medical students, but we also have a version for dental students. So I just wanted to share that, for any of the dental students that are here, you should have access to this as well. And it will help you determine what your best repayment option is going to be if you're going to residency or if you're not, in terms of your actual student loan data from studentaid.gov. I will say that I was told that they're doing an upgrade today on the calculators. It was supposed to be done by now, and I don't know, I haven't been able to check because I've been in the session with you all. So if for some reason you're getting a message, if you try to log in shortly after this and you can't, just give it maybe an hour or so, but I believe they should be updated, finished with that update. There's information on our website on how to access the calculator, but you should all, if you are a current dental student, should have access to this. Same for any medical students that are here. It's different calculators called the MLOC instead of the DLOC, but that's specific for medical students. And then again, the loan simulator through studentaid.gov. You can get to that by logging into your studentaid.gov account. Sorry. And then, or you can just, log in. I would recommend logging in because it'll pull your actual loan data, but you can use it without logging in. You'll just have to manually put in some numbers. So for those of you that are just trying to get an idea of what that might look like, highly recommend you do that. And then we also have a financial wellness program. This is available to anybody and everyone who is interested in just a general resource on financial topics. So budgeting, paying off debt, insurance, taxes, investment, anything to kind of get a good foundation of a financial topic. So if you have questions about, a certain, topic and you're not sure where to turn, kind of where to start, completely free resource. Once you have a login, you have access forever. Just a great tool overall for anybody that's trying to manage their loans, or not their loans, their money. There's a little bit in there about financial aid too, but it's not geared towards financial aid. It's just general financial information. So wanted to share that with you all. And then our email address is first@aamc.org. So if you have questions about the loan repayment, you're welcome to email us. It's myself and my colleague that will do our best to answer your questions via email as we can. And if you don't mind, if you can scan the QR code tonight and just share some feedback on this presentation. This does get shared with your school, so we want to make sure that you're getting value out of this presentation and we're providing what you're looking for. Highly encourage you to fill it out. It's completely anonymous, just a couple questions, but we really truly value your feedback. So I appreciate your time and your attention and your willingness to give that tonight if you're able to. And I'm going to stop here and we'll go through and see if we have questions that we need to go back
We
through.
have one last question in
Okay.
the chat or the Q&A. Is there any interest forgiveness for the pay program?
Okay. So when we talk about forgiveness with pay, this is part of pay being involved in this court case with SAVE. It had to do with this very thing, was with the forgiveness of at the end of 20 years on pay as you earn. So the IBR plan, the income-based repayment plan, was created by Congress and it's set into law. And part of that in the law states that after 20 years, any remaining amount would be forgiven. So on IBR, we know that's in law. For pay as you earn and an ICR, there was also forgiveness stated that you could have your loans forgiven. Same thing. After 20 years, if you still had a balance, whatever's remaining would be forgiven. That was not in law though, like that is with IBR plan. So that's the piece that's in question right now with this whole court case that's happening with SAVE. They pulled in a couple things with these other plans, and that's the piece of it with pay that's impacted. So we don't have clarity, I think, just yet on what happens if you still have a balance on pay after that time frame. I would normally say yes, that would be forgiven, but that's kind of what's been tied up with the courts right now. So IBR is your safest bet in terms of like the fact that it's in law and it would take a bigger change. But I can't say for sure if the pay forgiveness would be there after 20 years, but we also don't know what would happen to your balance if that payment plan's only 20 years, and then, what the expectation is with that afterwards. So, but in general, I mean, the forgiveness for the most part is all interest that's getting forgiven. If you're making decent payments on your loans over that long of time, it's the interest portion that's being forgiven. Sometimes your principal, just depending on how much you have borrowed initially. But it's a great question. It's just not something I can give you a definitive answer on at this time, unfortunately. Okay, and then I know you get the questions in the chat, or did you want me to go through any of those?
I think we got through them, but if anybody has any other questions, now is the time, even if they're specific or you think that they're niche, while we have the expert. Okay. As a reminder, this recording will be available to you later on, probably within a week or two on our website. And then we'll get the slides up as well. So feel free to reference this at any time. And if you have questions, feel free to reach out to us, or like Ann said, contact them through their organization as well. But otherwise, we'll stay on for a couple more minutes in case there's any last minute questions. But otherwise, thank you so much for attending. And I hope you have a great rest of the year. Oh, I think we have a question.
Yeah, so we have a couple. Okay, so is interest accruing during medical school? Yes. If you have any unsubsidized loans, so generally that's what you're borrowing when you're in medical school, the interest starts accruing the day that you start borrowing that money. Unfortunately, subsidized loans are only available to undergraduates, and that's the loan type that you wouldn't be accruing interest. So yes. And then what will be the best option when filing joint taxes? That's a question that you'll have to ask yourself, I think, in terms of what you have to look at your overall financial situation between both of you. If you file married filing jointly, just know that both incomes will be included to determine that payment amount. If you file married filing separately, then just the borrower's, income would be included, but there may be tax implications of doing so. So, some just general advice around that would be, maybe file your taxes or don't officially file them, but run through the process if you're using TurboTax or H&R Block or something as married filing jointly, and then do it again, married filing separately, and see what type of impact that has on your taxes. If you're gonna owe, if you end up owing, or one of you ends up owing because you filed separately, then you have to look at, is the amount that you potentially could save on an income plan just based on your income alone worth filing separately? Talking to a tax planner or a tax advisor, even going somewhere like H&R Block and having them help you would probably be a good idea. But, working with a tax professional to help you determine that. There's unfortunately not, it's going to be different for everybody. So you really have to figure out what your finances look like and what your spouses do as well. So to apply for the IBR plan, you have to fill out the income-driven repayment plan application. So that is going to be available on studentaid.gov. It's called the IDR, so income-driven repayment plan application. So when you pull that up, it's all electronic. You log into studentaid.gov and you apply, and it'll ask you specifically if you know which plan you want to choose. Or if you want them to put you on the plan with the lowest monthly payment. So if you know IBR is what you want, you select that and then you answer the questions from there. So if you call your servicer, they're going to tell you to do the same thing. Go to studentaid.gov and fill out the form. I would anticipate, if you're graduating soon, that if your grace period is 6 months and you're entering, first payment is probably going to be due in December of 2025. So sometime between August and December, you should start getting notifications from your loan servicing company. They'll provide you with your payment due date, how much that payment would be on the standard plan, and then steps to take if you need to lower that payment through IDR or through income driven repayment. So you'll get more information as you get closer. I know right now, if you've borrowed loans, you just haven't heard anything, you're like, well, what am I supposed to do? You will start getting information from your loan servicer, and then go through that exit counseling through studentaid.gov. I believe you're required to do that through by your school as it is, but that's going to give you more information on your next steps and kind of where to find this information. The studentaid.gov is going to be your source of kind of your next steps, regardless of which payment plan you choose. That's where you're going to need to be able to log in and see your loan data and make those decisions. See, there's a couple questions about interest. Yeah, and studentaid.gov, like I said, it has a ton of information there for you. So you can log in, click on the details of each of your individual loans and see exactly how much interest you have accrued, what your interest rates are, if you're trying to familiarize yourself with all of that. So definitely, and don't be afraid to reach out. Your financial services office seems very willing to meet with you guys and answer these questions. So take advantage of that while you're still here and able to have that resource, because they will be able to actually see your loan data as well and be able to provide some more clear guidance just based on your individual situation. So definitely take advantage of their help. So, but thank you all for your participation. Good luck to all of you. Congratulations, and we wish you all the best.
Thank you, guys. Sorry, Stephanie told me to apologize. It was more than an hour, but